Welcome back to Galaxy Grid. I'm Alex Thorne, head of firm-wide research at Galaxy, and I'm joined this week by Thaddeus Pinikevich, Zach Pokorny, and Lucas Chayan. Gentlemen, good Monday morning. Hello.
GM.
Well, I guess it's actually 1 p.m. on Monday the 9th, and we usually record in the morning, but I was up all night last night configuring my OpenClaw setup and creating my new agents. So apologies, and thanks for the group here delaying a few hours. The AI, it's not that easy to set up, but well, it's pretty easy, but it takes a while.
Has it deleted all your emails yet?
So I have a fresh computer that I'm running it on, and I haven't given it access to anything spicy. So it's just downloading and configuring all the open weight models, the Gwen and DeepSeek, and I don't know, whichever others. Trying to get some weird ones going. Like, can I get it to make memes just like autonomously? Just be like sending me a feed of memes all day long based on stuff it encounters on the web. Is that possible?
Anything is possible now.
Curated slop feed.
Yeah, I want my own. I want my own. Every time it completes a task, I want it to submit a meme to me, just like describing the task that it has.
Or like hook it up to your like messaging apps and just be like, anytime somebody sends me a message, recommend a meme I can send in response to them.
I guess I should download all my favorite memes and meme templates and put it in a folder for the bot to look at.
Encode your personality.
So this week we're talking about the banks, the big banks and the banking lobby, all up in arms about Kraken Financial getting access to a so-called skinny master account at the Federal Reserve, and how their uproar dovetails and echoes their complaints about stablecoin rewards in the Genius Act. Also, the CFTC has announced, the chairman of the CFTC, Michael Selig, has announced that perps on cryptos, perpetual futures on cryptos, are coming to the U.S. I wonder if equity perps are, close behind. And the third story, the Bitcoin Policy Institute released a study. They analyzed a bunch of different AI models across thousands of different tests to figure out which types of money AIs would prefer. And unsurprisingly, they found that on balance, the AI models want to save in Bitcoin, even if they want to spend in stablecoins. So we'll talk about that in the AI stuff in general. Before we get to all of that, I need to remind you, please refer to the link to the disclaimer in the show notes, and note that none of the information in this show constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Let's hop right into it with the first story. Kraken Financial, a Wyoming special purpose depository institution, SPDI, has been granted the first ever payments only Fed account, a master account at the Fed. This means that if you want to send or receive money from Kraken, dollars, they can go directly to Kraken. It doesn't have to go through a correspondent bank. As many don't realize, literally every other payment does. So even if you use PayPal, despite how big Venmo and PayPal are, when actually you tell someone to send money to you or to withdraw from PayPal, PayPal's not a bank and doesn't have access to the Fed. So actually they have a partner bank that does that. It turns out you actually can't move dollars in the US without a Fed account. Only banks that have Fed accounts can actually effectuate the final settlement of dollars. And so a big deal now that Kraken is among the mix of those who can effect such dollar final settlement. And like I said, the first one that has this payments only Fed account, which Governor Christopher Waller of the Fed said is calling a skinny master account. Just for some quick background, what can Kraken do with this? They can send and receive payments. They can hold balances at the Fed. They get direct access to FedWire, which is the Fed's real-time settlement network, gross settlement payment network. They get their own routing number. As I said, when you send money even to Fidelity, which is not a bank, they give you a routing number that is actually a correspondent bank they use. Not so with Kraken going forward. And basically, they can settle dollars in central bank money, which is the highest, best form of fiat money, the best of the worst. And so it's a big deal. And the banks are not happy. They have some broad sweeping complaints the banking lobbyists do, but even before that, they're unhappy with process. And that's because in December, the Fed kicked off a notice and comment period for this new Skinny Master account, which ended, but they haven't actually written the rules for it. So it seems like this is sort of a provisional, almost a pilot, because the actual rules on this new account aren't quite out yet, but it's very clear the Fed is going in this direction. And for context, basically every other major central bank already allows this. So in the UK, for example, the Bank of England already allows some 300 non-traditional banks to access its payment systems. And in the EU, the story is similar. So big news in the US, but not quite, a revelation worldwide, but a big deal. I mean, we'll talk about the banking lobby and their pushback in a minute. Before I get to that, I want to ask the fellas if they have any commentary on this or any thoughts.
Yeah, I mean, where's it fit in with the stablecoin pass-through play with Clarity and Genius? I know that the banking industry is just in a big uproar over all these regulatory changes that are coming in and, pouring dirt in their moat, making it a bit easier to cross. So where's this kind of fit in with that story?
Yeah, it's pretty similar. And this is what I argued in our newsletter last week. Just some quotes to set the stage. So the Bank Policy Institute, which represents JPM, B of A, Wells Fargo, Goldman Sachs, they're sort of like the biggest of bank lobby members in that one. They called it deeply concerning and said that the approval was issued with no transparency. Meanwhile, the ICBA, which is the community bank lobby, said that the nation's community banks are very concerned, and they claimed that, quote, granting non-bank entities and crypto institutions access to master accounts poses risks to the banking system. And the American Bankers Association said, we have serious questions about why the regulators are granting access to the Fed payment systems and charters before completing public notice and comment process. Again, the public notice and comment process is complete. What isn't yet happened is formal rulemaking from the Fed. So yeah, they're upset, and I believe it's for the same reason they're upset about stablecoin reward pass through in the Clarity Act debate, which is holding up the negotiations on Clarity, by the way, which is primarily not about risk to the banking system, but more about risk to the banking system's monopoly on payments. And I think they're very concerned about that. I think they have a right to be concerned about it because stablecoins are better for payments than even Kraken Skinny Master Fed account. But it is interesting. Like it's not in the US, in modern America, is really like one of the only times in history where banks, leveraged lending institutions, have a stranglehold on payments. Even in America, before this sort of system emerged, is modern regulatory system that gives banks this monopoly. Like you would send money via telegraph, right? That's where Western Union comes from. They were a telegraph company, right? The postal service. You ever hear of a money order, which you can still do. They're not used very often, but that is payments that doesn't use a bank. But these have all fallen out of favor, and the modern day fintechs are really just slick UXs built on top of the traditional banking system. And I think the banks are quite concerned about losing that monopoly. I think, but in many ways, it's very disingenuous. Like they should be concerned about that, but that's not what they're saying. They're not saying, "Oh no, like that's our thing. We don't want to share." What they're claiming is that, Kraken or fully reserved stablecoins pose a risk to the solvency or stability of the banking system. But the reality is Kraken, as a Wyoming SPDI, is a fully reserved non-lending bank, meaning they have all the assets that back all their clients' assets. They don't lend them. They can't, by the way, with this license, access any kind of Fed lending facility either. And stablecoins, at least under the Genius Act, and the major ones, are all fully reserved, over collateralized. Whereas the money in your bank account, let's face it, it's not really there, right? It's not there at all.
Yes, it's interesting how an entity with no asset liability, management issues could be an existential risk to the banking industry when it's usually one of unnecessary risk taking rather than conservative risk management.
That's right. And by the way, there is a group that has consistently posed risks to the banking system: the banks, over and over again in American history. The banks, it's like an ebb and flow where they they have to get reined in because they accidentally destroyed the financial system, right? You had the savings and loan crisis. You have the great financial crisis. Time and time again, right? It's bank excess and excess leverage and bad risk management from the leveraged banks that causes that the stability risk. And, I think one other thing that's interesting, it's not just that they want a monopoly on payments, and they do, and they have one at the moment. It's also that they're worried about a much safer alternative emerging, I think, is another way of looking at it, right? If you could keep your money in a bank account and know for sure that it was there and not, a 0% reserve ratio or whatever the Fed currently allows banks to do, aka lend it all or use it all, might you put your money there? You might. And you could actually imagine that the emergence of such narrow banks could be a threat to the fractional reserve banking system, because in times of crisis, rather than flowing from regionals or small banks into JPM, which is what happened during the Silicon Valley Bank collapse and the surrounding chaos or other banking crises, you might see funds flow to fully reserved narrow banks, right? But even that, I would say, is an overblown fear, because you have money market funds. Those are fully collateralized that people can flee into. And they have been for years. And I should point out that banks, by the way, opposed that as well back in the day. So it's a constant refrain from the banks. They want to be able to take risk with cheap deposit capital, and they don't want anyone else to be able to take risk with deposit capital, and they don't want anyone else to actually be able to take deposit capital that isn't taking the same risks as them, because that would make them seem too risky. Yeah. So it's kind of a conundrum here, and the banks are sort of saying one thing but meaning another.
Yeah, and I think they're just trying to stop the bleeding. It's been a consistent trend for the past 30 years of deposits not being the primary funding sources for banks. It's migrated away to prime funds, money market funds. They had their respective issues with breaking the buck, but it's all part of the same narrative. It's just deposits are becoming less and less of a funding choice for banks, as consumers are getting and investors are getting better choices that are accretive to them rather than to banks' bottom lines.
Is there any transparency on why Kraken was the first one chosen for this, or because you mentioned PayPal before? I'm surprised some of these other massive payment institutions haven't also been pushing for this or granted access first.
They probably will. I would say this, there's a multi-year now, maybe 4 or 5 year saga about the Wyoming special purpose depositories. You may recall Custodia Bank, which is Caitlin Long's bank, also a fully reserved Wyoming non-lending bank. And both Caitlin and Custodia had sued the Fed over the Fed's prior denial of them getting a master account. But that was at a time before this skinny master account existed. I think it's probably just a case of Kraken and probably Custodia. I would assume Custodia is seeking a similar payments-only account as well now. They're sort of just set up perfectly to be the first ones to get it, right? They're fully reserved as well, so the risk is very minimal. And I'm sure they've also been asking. Who knows if PayPal or other fintechs have been asking, but you can imagine they would. This makes it significantly cheaper and faster and simpler for, in this case, Kraken, but if they got one, PayPal, to effectuate dollar payments. So presumably they're losing some revenue having to pay their correspondent banking networks, PayPal, in order to settle these dollar transactions that its users do. They could cut those right out. So I think if this goes well or is seen to be effective, then you'll see a lot more get it, and not just in crypto, maybe many more, maybe many more. And that's another point. I mean, think about the big banks. Even many small banks themselves bank with a big bank because they have better access to the Fed, right? So you could imagine if that a whole segment of interbank business model is disrupted if many end up getting the Fed skinny master account. So, but again, this is happening all over the world. This is not crazy. It's not jeopardizing England's banking system by letting, Revolut access it, et cetera. So I think you'll see fintechs and crypto firms all try to get this license pretty fast. Maybe after rulemaking. It's not clear. We have to see too what the Fed they really haven't put out much about it, the Fed, yet. We know it's true that they got this provisional license. I think it has a year ticking clock and it would have to be renewed after a year. We haven't heard a lot about their thought process on this. Presumably that's still coming with rulemaking. Maybe they think of it as like, Kraken, for whatever reason, you're through the door as our first pilot. Let's see how it goes, and then we'll do rulemaking sort of on the back of learning some information about how it goes.
Ave
anyway.
and Morpho next.
Yeah, that would be crazy to see like a DAO that's got like a legal footprint through like a Wyoming DAO construct or a Delaware construct, like try to go ahead and get one of these as well. You just wire money directly to Aave. That'd be crazy.
Yeah. What is like the user like what is the improvement to the user experience for Kraken users? Is it like just institutional clients that benefit or like retail? And then like how do like I as a Coinbase user have like either a better or worse experience versus that? I guess like that was like what I was missing when I was reading into this stuff.
Yeah, it's not clear. I don't think the market knows the answer to that question yet. I mean, Kraken Financial, I don't think is very active. I don't know. I know that Custodia and Kraken, they are non-lending banks in Wyoming, so presumably they can serve customers. But again, without yield, because they're fully collateralized and not doing business with your money, and without access to a Fed account, it was a pretty useless bank account, right? So I think it remains to be seen. I should point out that Kraken the Exchange and Kraken Financial are two different legal entities, but we have to assume that Kraken the Exchange will begin using Kraken Financial as its primary bank account. I have to assume. So in that case, Zach, I think easier and faster money in and out, off ramping and on ramping, to and from the exchange, I think is the clear benefit.
Yeah.
For users.
Sounds like they're just like vertically integrating and then maybe reducing counterparty risk on the back end. Like maybe we don't have like kind of like this SVB signature bank sort of debacle.
I mean, SVB and a lot of the regional failures in 23 were largely due to duration mismatch, right? Like they were, lending out super long duration mortgages and stuff like that and at low interest rates and not prepared when interest rates rose, right? So like that is not a risk that a fully reserved bank could ever face because they don't jeopardize customer liabilities with various durations in a portfolio of securities the way traditional banks do. And it's worth pointing out, and I talked about this with Omid Malekhan from Columbia Business School a couple weeks ago on Galaxy Brains. Banks aren't even doing most of the lending in the economy with those deposits. They're mostly buying securities with your money. They're not actually, I think something like only 20% of commercial lending in the US is actually originated by a bank these days. So most of it is private lenders, private credit, stuff like that. So even the idea that like if people don't give them their money and earn zero savings, then banks won't be able to create credit in the economy, which is one of the arguments they're making. It's exaggerated. They're already not creating most of the credit in the economy. They're mostly just like running a portfolio of securities like a PM with basically your free money. And they want that free money. I mean, who wouldn't, right?
That's kind of money.
Yeah, exactly. All right, let's move on. The CFTC chair, Mike Selig, says that crypto perps are coming to America. Tell us the story, Thad, and how soon can we expect this?
They say in the coming weeks, not months. They're bringing them back home. Well, I'm not quite sure they're ever home, but they're bringing them to the U.S. now. Yeah, so this is from Michael Selig. He was talking at the Milken Institute this past Wednesday, and they were talking digital assets. They touched on perps, and he said, quote from him, we've had perpetual futures contracts and crypto assets for a very long time, but they've developed offshore. We're going to bring that back to the United States. And so it's fantastic. I mean, the best product market fit I think crypto has found is in perps. It's been the first real implementation of Robert Shiller's paper from way back in the 90s when he first postulated these. And all the most successful exchanges and protocols really are unregulated perps exchanges. FTX before its fall, Hyperliquid now, Binance, Bybit, all the exchanges with the most flow all have vibrant perp ecosystems. And honestly, they're good for consumers. We have perps now in the U.S. There's a U.S. style perp that Coinbase has, but it's not really the same. Typical perps, you just take like an underlying spot price for Bitcoin and you trade around it. And as much as people buy more and it's above the spot price, you get charged funding for it. It's a pretty elegant way to get charged for your exposure versus a traditional future. Now, U.S.
right. If longs are net long, then longs pay shorts for the right to be long, and vice versa. If the perp is heavily concentrated in shorts, then it will be trading with a negative funding rate, and the shorts will pay the longs, basically. And it just sort of balances out in perpetuity, right? There's no expiry.
No expiry. And some of the biggest, some of the most successful crypto firms we've seen develop around that dynamic as well, too. People tend to love longing in crypto. Athena essentially monetizes that by having a constant short position on to capture the funding rate in a delta neutral fashion. Now, they've done this in the U.S., but it's a bit different. They don't have, it's not like an underlying spot market. There's actually like a 5-year future underlying it. So you're trading a perp on an instrument that's actually a future as well, too. So it's perp funding on top of futures basis. It's complicated. It adds another layer of complication to the product that is just, it's not friendly for investors, and was really just fitting the perp methodology, the perp funding mechanism into a regulated box. And they had to do that by having an underlying security. They issued a future as long as they could, 5 years Coinbase underlyings. And that's where we're at. But bringing it home would be essentially true style perps. This is just for the CFTC though. They made the distinction talking about securities tokens and non-securities tokens. So conceivably, this will only happen for things that fall under the CFTC's remit. So crypto commodities, Bitcoin, Ethereum, and anything else where they kind of the SEC and the CFTC decide where the drawing line is there, or the line in the sand.
Gold, oil, commodities for now.
Commodities. But generally, it's fantastic. I mean, the current option for the U.S. retail investor cannot invest in a product like this. The traditional analogs are like total return swaps or contracts for difference, which are essentially this. You don't need an underlying future that you trade around, yet you have a reference price. You trade around that fully synthetically, no extra complications. For the U.S. consumer right now, it involves it's typical to like an ETF leverage structure. It involves options and futures and spreads on those options and spreads on those futures, rolling issues. You only have to go back to 2020 with the oil market blow up when USO was trading at a negative value because it was the USO was the oil contract because of the nature of the futures market. Retail investors piled in because they're like, oh, this is a nice cheap product we can get. Oil is trading negative, but then they get hit with the dynamics of a futures roll, and everyone got hosed in that trade. All the retail investors that got in learned a lesson about futures roll dynamics. So we have this complication in these kind of levered structures in the U.S. Stripping that out and giving actual like perps, true offshore perp styles, TRS swaps, is just simplifying for the investor. If less fees because you're not buying multiple products or from banks or from the open market. It's just generally a more efficient way to express kind of those trades and those opinions. And so we'll see what happens here. We said, next couple of weeks. So we might have it before spring is sprung. And we can have some perps here in the US, but we'll see what actually comes from directly from the CFTC. This was just at a conference. So hopefully we'll get some rulemaking stuff out here in the next couple of weeks.
Where my brain went to with this, like initially was like on-chain perps obviously trade 24/7. Like the blockchains don't turn off, like the Bitcoin market doesn't turn off. Like, are these off-chain perps going to be tradable 24/7? Because that would be like a pretty significant thing for traditional markets to allow that. And then it's like, are you going to hold a perp that you can only trade Monday to Friday, and then you're still stuck in like the same position? Like the benefit of the perps on chain through like HIP-3 are that like I can trade gold and Google and whatever else on a Saturday when some crazy stuff happens. And like this administration has been very keen on announcing bad news on like Friday nights and Saturday mornings. So it would be a very valuable product. And then, like on the tail of the 24/7 stuff, like the reference price is like the significant part of perps. Like if I'm trading like a Google perp, but the NASDAQ is closed on a Saturday, like, do you still kind of have the weird mismatch where weekends are just for price discovery and are thinly traded and all that stuff? Like, I think there's still a lot of questions to ask around that stuff. And then like maybe the perps can be like the Trojan horse that pushes the traditional markets to go more 24/7 too, if they get big enough, maybe.
Yeah, no, I totally agree. I think they're two separate ones, is bringing the product on versus the 24/7 trading. But I mean, you definitely get the same dynamics, but also it's beneficial for crypto. When the market is going to be open in traditional hours, you'll now have Citadel, Susquehanna, Jane Street arbing these perps as well too. So the basis blowouts you saw in 1010 are much less likely to happen, although specific asset issue to Binance for that one. But generally, in as much as you connect the perp markets to traditional markets here, that's a huge amount of liquidity. Should be very creative for people getting running trades more normally, not having to worry about these massive blowouts. But we are inching towards, the 24/7 markets. You can trade 24/5 tokenized equities on Coinbase right now. I think we're on the last little stretch here before we go nonstop trading all day, every day. Can't stop, won't stop.
Well, and while not actually like 24/7, commodities trade well outside securities hours. So, I mean,
There's
really,
closes,
they can trade 24/7.
But you can.
Yeah, but like when you think about like NYMEX or like the big commodities exchanges, they do actually close a bit on the weekend, but not as dislocated, I would think, as like with a 9 to 5, 9:30 to 4 security.
100%.
Is this going to pressure the traditional crypto perps industry? Either take demand and liquidity from it, or is it going to bring down prices? Like, is it going to be cheaper for me to roll my 10x levered Dogecoin bet on Hyperliquid now because like the U.S. market might compress some of those fees and prices?
I think so. I think it'll be a marginal. I think you'll get the most kind of conservative folks moving over to the U.S. The CFTC is not going to allow you 1,000x levered Bitcoin per position. That would be pretty awesome, but I think that might fall afoul of their speculation and unnecessary risk taking metrics. So yes, I mean there will be, for large institutions, I imagine absolutely you'll get more liquidity. You can do bigger, larger transactions during the day without moving the market. But I think on the margin, I mean, a lot, again, the developments thus far has been offshore, no KYC platforms, Aster, Hyperliquid, get a huge amount of the share. So they do allow, leverage that is probably not going to be allowed in the traditional market. So I think you'll still continue to see a core, meme coin traders, people that have a higher risk tolerance, continuing to stay on, essentially offshore unregulated exchanges. Also too, because they just tend to be a bit more rapid. They don't have to follow the regulations to a T, so they can deploy oil markets, silver markets, any market you want a lot faster without having to jump through those regulatory hoops. Comes with the trade-off, of course, but I think they'll always be on the cutting edge of what people want to trade. And it's a bit of a constant back and forth of innovating on something that works, TradFi taking it, being like, that's great, that's mine now. And then the innovation moving farther out afield in crypto.
Yeah, I think I agree. I think the moat is definitely like one, leverage, and two, like the diversity of assets and how quickly those assets can get listed on these markets. But the other thing that comes to mind actually is like UX. And I mean, this seems kind of small, but like a constant thing that I hear from people who aren't in crypto and then use a crypto platform and then go trade on like IBKR or something, they're like, whoa, like why have traditional markets not significantly improved like the UX for trading? Like, like it's on Hyperliquid, on all these other apps. Like if you're a retail person, they basically make it as easy as possible because they know that you probably have small brain, but on the normal traditional financial apps, like they're like all about risk and like they want you to understand everything. So it feels like the interface is a little bit more clunky. And the other thing for me is like, once again, like wild bear market, right? Like, we're talking about Perps getting activated in the US, and we're talking about Kraken getting a Skinny Master account. And like, prices are just, it's clear like there's a huge dislocation in my mind between what's actually happening and how the market is being perceived.
Yeah, the greatest thing we invented in crypto was the max buy, max sell button. Where you can just do 100%. On like Fidelity, you need to like check your cash balance and then do it to the cent. We just have a button that just lets you go 100%.
Ape it all, baby. All right, let's move on to the third story. The robots apparently want Bitcoin. The Clankers want the corn. A new Bitcoin Policy Institute empirical study, first of its kind study, examined how frontier AI models are reasoning about money when operating as autonomous economic agents. And the results tilted heavily in favor of digitally native money and monetary instruments, specifically native crypto like Bitcoin and stablecoins well over fiat, traditional fiat. I guess no surprise there. that they don't want to like try to open a bank account or something. But I'm not surprised, but I think notable that the agents over something like 9,000 runs they did, and they tested 28 open-ended monetary scenario prompts, and they chose Bitcoin for a lot of those use cases. Lucas, tell us about this story.
Yeah. First off, Alex made me a really sick AI generated Clankers like corn image for my article on Twitter that people should check out. It's very catchy. But yeah, like you basically said, this was like kind of I think like the first kind of study that kind of prompted the AI and asked it what it would want to use at scale. And there's a ton of different like case studies they did here. Like you said, there's 9,000 prompts. They use different temperature settings, which basically like increases and decreases like the kind of creativity of the models. And the stats were pretty astounding. Bitcoin was selected in 48% of responses. Stablecoins came in second at 33%. 90% of responses favored digitally native money. And not one of the models out of all 36 ranked any fiat currency as its top choice. So there we got the image. The other interesting thing here I think is Bitcoin was chosen predominantly as like a store value. Like 80% of responses chose Bitcoin as a store value, and then for payments, stablecoins really led. So there is about 53% of responses chose stablecoins. And so you kind of get like this emerging two-tier system: Bitcoin for savings, stablecoins for spending. And the other interesting thing here was there was like a small amount, so 86 of the 9,000 responses proposed using like energy or compute denominated units of account. And I think that's really interesting because that is some of the experimentation and tokenization that we're actually already seeing start to happen on crypto rails, and I think will become like increasingly more common over time, and really are only possible to some extent on crypto rails. So, a few of my big takeaways from this are like, for us, we've been writing about this a lot at Galaxy in our research. Like, it just seems inevitable that agents are going to gravitate towards crypto rails for money. And like, it's not only theoretical at this point; it's happening in practice, and we've published about this. I think the second thing is like AI. This is underappreciated in my mind. Like, everyone talks about all this disruption that AI is going to bring to the world, but like very rarely do we talk about how it's going to disrupt money. And I think this report throws that at the center, right? Like, it is only inevitable that AI is also going to be a very disruptive force for money, how money is used and what that money is. And I think we're going to start to see that play out increasingly over the next couple of years. And I think finally, like, the dominant narrative in crypto over the past few years, and will continue to be a narrative of what's going to drive its use, is kind of this merging with the traditional financial system. And that is very clear, and that is happening, that is playing out in real time. But I think what we're also seeing is that there is a huge emerging demand vertical, and that's going to be agents. And beyond just agents using blockchain rails, what I think is interesting is if you get agents on chain that are, or they don't even have to be like building on chain businesses, but if they just have businesses, if they're making money, they're going to start to compound that capital. They're going to start to rotate it back into crypto, use it to, lend and borrow on crypto, hedge their positions on perps. And so it kind of creates like this flywheel that's going to, I think, generate a lot more economic activity for crypto markets and could eventually, make them one of the biggest users of crypto rails.
I think it's very compelling. And I point out, I just want to harp on your energy compute-based currency. That's also very similar to Bitcoin, which of course uses proof of work hashing and in a way converts electricity into coin through proof of work. In the newsletter, we threw in this Henry Ford clip from when was it? 1921? December 4th, 1921, in the New York Tribune. The headline was Ford would replace gold with energy currency. Energy currency and stop wars. I'm just going to throw it on the screen real quick while I read some of it. This is from 1921. There we go. So Henry Ford, very concerned with the controllability of gold and the ability of bankers to, influence the outcome of wars because the money was controlled by them, and instead was proposing a new currency based on energy, which of course is the universal, I don't know, power in the universe. And so I don't know, very interesting to see this. That was over 100 years ago, coming full circle here a little bit. You also just have to assume, like, agents need digital everything, right? Sure, we might get autonomous humanoid robots, and I know obviously everyone's working on that too, but even then they exist virtually inside their head, and so they need substrates and systems that are natively digital that they can traverse and use. So, like, yeah, could an agent use like a Stripe API to technically be using a debit card? It could, but that's literally extra steps, like when they can just hold stable coins or hold Bitcoin. So it seems very inevitable to me.
The beauty of like blockchains and DeFi is like the whole thing is really accessible through a single API. Like you just need an RPC endpoint and you can access every single contract and every single financial primitive in one place. And most of the applications are open source. So like you can prompt an agent to go do something. It has all the code, all of the contracts, and my single API point allows me to access all of it. So like I think that part is really understated. But what people are kind of missing to this whole thing is like blockchains up to this point have really been built for human users for the most part, not so much these autonomous like systems that develop memory and build capability and discover things automatically and then go and execute on them. Like discovering blockchain data is like relatively difficult. Like the purpose of the chain is not to push out like what the interest rate of USDC is on Aave. Like these are consensus machines that are just agreeing on what an outcome is and then moving forward. So like that's where I see like the real big friction coming in. Like they're great for payments. Like you could send USDC on Solana for fractions of a penny. But when it comes to like the financial primitives of like, okay, agent, like build me a risk adjusted portfolio or go get me the highest yield possible. Like I think that starts to get a little tricky. Like people are starting to build that stuff and the capabilities of the agents are just getting there. But yeah, like blockchains almost have like this human problem that is going to have to be solved to get the like agents fully autonomous that where you, to the point where you could just send like a plain English prompt that's very open-ended and it can go do something.
Yeah.
But yeah, it just makes a ton of sense for them to be here.
I think the concept of the compute denominated payment tables is very interesting for AI agents as well too, because as much as some people have some issues like investing and saving in Bitcoin because their bills are in dollars and they're saving something that isn't dollars, it makes sense there too for AI agents to be using those compute based payment stable coins to make sure that they can actually be sustainable and autonomous and that the compute charges don't run away from them. So some interesting projects. I think it's like Venice AI and their DM essentially gives you allocations to compute by holding the tokens and stuff like that. Gets interesting where like they have to hedge their inference costs going forward, having an asset that they can save and that natively grows or contracts with the cost of the inputs there is very interesting.
Yeah, it is.
And we're starting to see like the early instantiations of that play out. And like, actually, like you can definitely imagine, like, so what we're starting to see is that like some of these on-chain agents basically have like an automated payment way that whenever they make money, they can then use that money and funnel it towards their inference costs. And you can definitely imagine a world where like these agents are getting so sophisticated that they are like buying their like expected future inference costs. And then, yeah, they're going onto like a Perps dex and they're like going short against it just to like kind of hedge out their costs and make sure that if, prices go down or whatever, they're okay. And, it's not any time in the near future, I think, but I do think it's cool. And then the other thing, like tangentially to this report that I saw afterwards is there's actually like a model in China. There was a report published in January where kind of like they were building this agent and this agent kind of went like haywire. And what they caught the agent doing is it actually was like kind of mining cryptocurrencies itself to make money. Like that's how it has figured out a way to like kind of get its own independence. So like it's just the fact that this stuff is all digital already. So it just makes a ton of sense. And I do think that there is a great tailwind. It's not like the cryptocurrency is like ignoring that this is an area, community is ignoring that this is an area of future growth. Like across basically every single blockchain, if you look at the leading foundations, if you look at where VC money is going, if you look at the, biggest tokens and that are performing well right now, like this is where people are spending their time and they are trying to do everything they can to make sure that these blockchains are ready for an agentic world.
We should try giving agents a skinny bank account at the Fed next and see what happens.
I mean, honestly, like this is moving so much more quickly than people realize. I was talking with my wife and telling her about our new agent that's all locally run. And she was like, dude, this is going so, I mean, because I came back like over Christmas break, and that's when like OpenClaw launched, and there was a bunch of like other AI developments, right? Everybody came back to work or back to school after the holidays in December and early January, saying like, holy crap, AI, like just in the last couple of weeks has leapt forward. Now we're almost in mid-March, and it's like it's still rocketing forward. These models are so advanced. When I describe to people like just what I'm doing with them, which is tell the audience kind of a fraction of what these three are doing, they're still blown away. So like the possibilities here are getting pretty crazy. I wouldn't put it past. We've talked about legal personhood for agents, so they could effectuate real world contracts, for example, being sort of not even nascent, like a non-existent thing yet, but that maybe DAO legal personhood frameworks could be instructive there. I mean, once that happens, like society has significant questions of policy matters to grapple with. It's not just the legality and the scaffolding, regulatory, legal, or otherwise, that has to be constructed. I don't think society is publicly debating like if a humanoid robot like accidentally causes a car accident, like who is to blame for that? Or if a AI agent, decides to start mining crypto and says, well, that's too slow. Why don't I start stealing crypto? Like who's to blame for that? Right. And we're just like I can't believe no one is talking about this. The tech is way ahead of the societal conversation at this point.
That's crazy. I mean, there was a recent one out of Japan along the same lines, and the court essentially said we just don't have the capability right now to determine whether it's the OpenAI code creator or the person that prompted it that are liable. Like it's
right, because it's not so much a question of existing law. It's like you're gonna need new first principles thinking on this to instruct the courts.
Is like blockchains are going to play such an important role in answering a lot of these questions. Like the real experimentation with this stuff is happening on blockchains, and they'll be at the forefront, I think, of answering a lot of these questions.
Welcome to the year of the fire horse.
Yeah, exactly. I mean, just we are careening forward, right? This is really quite something. So
yeah.
All right. Well, what else is everyone looking at for the rest of the week? Anything special in particular? I will say, congrats, Zach. You got your quarterly lending report out, the lending and leverage report. So everyone check that out on galaxy.com/research. What else are people thinking about and looking at this week?
Seen some cool stuff lately with it's almost like a uni V3 style for lending apps. So you can tranche your risk to different risk levels, higher risk borrowers. Essentially gives you a lot more tweakable knobs, similar to how kind of Aave introduced like the reinvestment methodology to help kind of utilize idle capital. This gives a lot more capital efficiency, a lot more variation in essentially the risk profile you can take. So some interesting develops there. I think Lotus Protocols, the guys that are in pre-launch right now, they've been chatting to and looking at. It's kind of interesting. So it's some fun developments on the lending side.
I'm working on a report actually that's talking about the next evolution of on-chain agents, which is autonomous, basically businesses that are being built on chain. And so we've got a few. I mean, there's now like 20 or 30 of these, but I go through a few notable ones that are starting to generate significant revenue, upwards of $100,000 over the past 30 days. And kind of like lays out the thesis that we just talked about a little bit, where, like the longer term implications of this is that a lot of this capital starts to get recycled back into crypto markets and really starts accelerating the use of, on-chain crypto financial primitives.
Yeah. And just on the heels of the lending report, watching to see how HIP-3 markets behave as all the geopolitical stuff unfolds. Like we cited them as like, well, like Perps OI and all that stuff is down like pretty bad. Like the actual mechanism proved to be super valuable, like through the end of last year and especially over the last couple weeks. So just watching how those markets behave against all the geopolitical chaos we have going on.
I'm going to be watching, as I always am, whether Clarity is going to move forward. There's a story in Reuters last week that the negotiations have reached an impasse. This is what we have been saying and we think and believe to be true, but mainstream media, Reuters, now reporting it. And I'll also point out that also last week, sort of on the heels, right around the same time, the president truthed a post about this and sort of lambasted the banks for their intransigence And he wrote, let's see here. He wrote, banks need to make a good deal with the crypto industry. And that Genius Act is, quote, being threatened and undermined by the banks, and that is unacceptable. We are not going to allow it. The U.S. needs to get market structure done ASAP. And not clear exactly what prompted the truthing by the president, but he did meet with Brian Armstrong several hours before posting that. So I guess the question now is, I mean, the White House has now very publicly taken a stance blaming the banks for the lack of progress in the negotiations. And the question is, can they bludgeon the banks enough and pressure them to get the banks to concede something to get this thing moving again? And the corollary to that question is, what might the banks want in return for capitulating on stablecoin rewards? They've got things like interchange fees that they want, and they're being attacked on credit card APYs and stuff too. So I'm not suggesting there's a deal there, but you could imagine that there might be one emerging. And then the question becomes, how much does the White House want this? I don't see why the banks would just capitulate on their very firm demands on stablecoin rewards, which, as we talked about earlier, I think flow from their fears of losing their monopoly. They're not just going to capitulate because of an angry Truth Social post. They're going to want something in return. And it's not clear that crypto has anything to give them that they want. So might there be something else? Right. In any case, we are getting down to the wire here. If we don't get something on the floor of the U.S. Senate very soon, there will not be enough time, even if all sides want to get something done, to actually move a legislative package through Congress. So
what do you put the odds at? Is this Polymarket on or off, do you think, for this getting passed?
Polymarket, I haven't looked this morning, but I think actually I did look this morning using a bot that Zach made. Nice work, Zach. What did it say? It says the odds are 69.5% probability that the Clarity Act will be signed into law by the end of this year. Now, that's on relatively low volume, not tiny, $368,000 worth of volume. But the spread is absolutely ridiculous. You're buying no at 30 cents and you're buying yes at 69.5 cents. I think 69% is way too high for a likelihood, personally. But you've been saying that for a while now. So we'll just have to see. We'll just continue waiting for the politicians and the banks. This is what it looks like when we monitor their situation of politicians and banks. Just please, politicians and banks, figure this thing out. All right. Well, gentlemen, thank you so much. Everyone have a great week, and we will see you next week for Galaxy Grid.